All right, let's dive right in. Today, we're connecting the dots on some major financial news that's moving the markets.
You know our motto here. Our whole goal is to give you the key, market-moving news and the timeless wisdom you need to navigate it. And boy, today's events are a perfect example of why you absolutely need both.
So, the week kicked off with an absolute geopolitical shockwave. Over the weekend, markets were bracing for the worst. Tensions were escalating between the US and Iran. But then, Monday morning hit, and it delivered a twist that pretty much nobody saw coming.
Talk about whiplash. On Saturday, you have President Trump issuing this very stark 48-hour ultimatum to Iran. The whole world is basically holding its breath. Then, right as that deadline was about to expire on Monday morning, a surprise announcement just completely flipped the script.
And this was the post on Truth Social that just stunned the global markets. Instead of an escalation, President Trump announced a de-escalation. He claimed that very good and productive conversations had happened, leading him to order a 5-day pause on all military strikes.
So, how did the financial world react to this sudden pivot away from the brink of conflict? Well, the answer is instantly and dramatically. The numbers really tell the whole story.
You could almost hear a collective sigh of relief from the market. Oil prices, which had been spiking on fears of a supply disruption, just tumbled more than 6%. At the same time, U.S. stock futures, which had been really on edge, rallied immediately. It's a classic risk-on move, you know? The fear of conflict just evaporates and all that capital flows right back into assets that are expected to grow.
Now, to really understand why this news caused such a massive swing, you have to understand this waterway, the Strait of Hormuz. It's basically the jugular vein of the global oil market. We're talking about roughly 20%, 1/5 of the world's entire oil supply passing right through it. So yeah, any disruption here sends shockwaves through the entire global economy.
But just as the markets were celebrating, the picture quickly got, well, a lot more complicated. Conflicting reports started to surface, and for policymakers like the folks at the Federal Reserve, the uncertainty was far from over.
And then came the contradiction. So, while the White House was claiming these productive talks happened, Iranian state media flat out denied it. They called the whole announcement psychological warfare. This he said, she said dynamic just threw a bucket of cold water on all that initial optimism, and suddenly everyone was left wondering what was actually true.
This quote from the Chicago Fed President Austin Goolsbee just perfectly captures the dilemma. I mean, how can the Fed set interest rates and make sound economic policy when they have absolutely no idea what's going to happen next? This kind of geopolitical headline risk is a massive wrench in their plans.
And this is crucial. Despite all the drama of the day, the Fed's primary battle is still with inflation. Goolsbee cautioned against repeating what he called the team transitory mistake of 2021. That's a clear signal they are determined not to underestimate inflation again, no matter what headlines are driving the market on any given day.
All of this chaos, the tweets, the conflicting reports, the wild market swings, it actually sets the stage perfectly for a piece of timeless wisdom from one of the most powerful people in finance, which also just happened to be released today.
We're talking about Larry Fink, the CEO of BlackRock. And to put this in perspective, he runs the world's largest asset manager, with a staggering $14 trillion in assets. So yeah, when he speaks, investors listen. And his annual letter could not have been more timely.
And this is his core message. He's arguing that the real danger for us as investors isn't necessarily the bad news itself, but getting so caught up in the daily noise of headlines that we completely lose sight of our long-term financial goals.
And he's not just offering an opinion either. He's backing it up with some really powerful data that shows exactly why trying to time the market based on daily news is so often a losing game. Just look at this. Over the last 20 years, staying invested in the S&P 500 would have done you very, very well. But what if you panicked and missed just the 10 best days in the market? Your total returns would have been cut by more than half. I mean, think about that. Just 10 days.
And that statistic leads directly to this conclusion from Fink. It's a simple but incredibly profound piece of advice. The most important decision isn't when to get in or out, but simply to stay in.
The cost of missing out is just staggering. A dollar invested in the S&P 500 over the last 20 years could have grown more than 8-fold. But miss just those 10 best days? That slashes your growth by more than half. And here's the real kicker. Some of the market's absolute best days often happen during the absolute worst headlines, precisely when the temptation to sell is the strongest.
Which brings us to a final question. Today's events, as intense as they feel right now, will eventually be just a blip in market history. So take a look at your own strategy and ask yourself, is it built for reacting to today's headlines,
or is it built for the decades to come?